Slashing cash ISA limits, a misguided move to boost the stock market? Here's a bold claim. Reducing the annual cash ISA allowance won't magically turn cautious savers into stock market enthusiasts. In fact, MPs are warning Chancellor Rachel Reeves that such a move could backfire, potentially driving up mortgage costs instead. But here's where it gets controversial. Is the government's focus on shifting savings to stocks missing the bigger picture? Let's dive in. Currently, adults can stash up to £20,000 a year in a tax-free ISA, splitting it between cash and stock market investments as they see fit. In the 2023-24 tax year, a whopping 66% of contributions went into cash savings, a clear sign of where most people feel comfortable. Earlier this year, Reeves hit pause on plans to slash the cash ISA allowance, but whispers are growing louder that it might still be cut to £10,000 in next month's budget. The goal? To nudge savers toward riskier investments and spark economic growth. But will it work? The Commons Treasury Committee thinks not. In a recent report, MPs argued that cutting the cash ISA limit is unlikely to push people into the stock market. Instead, they emphasized the need for better financial education to empower savers to make informed choices. And this is the part most people miss. It's not just about money, it's about changing a deeply ingrained culture of saving. Martin Lewis, the founder of MoneyExpert, put it bluntly: the idea that stopping people from saving in cash will make them invest in stocks is false. For that to happen, we need a cultural shift. The committee also heard from building society bosses, who warned that reducing the cash ISA allowance could harm homebuyers. Why? Because building societies rely on savings deposits to fund mortgages. Less cash flowing in could mean higher mortgage rates, a double blow for those already struggling to get on the property ladder. Meg Hillier, the committee chair, summed it up: "We support the Chancellor's goal of helping savers earn better returns, but we're far from achieving that. Now is not the time to cut the cash ISA limit. The Treasury should focus on equipping people with the knowledge and confidence to invest wisely." Without that, she fears, Reeves's plan to transform the UK's investment culture could fall flat, hurting both savers and mortgage borrowers. And here's the kicker: even if the cash ISA cut goes ahead, it's just one of many controversial measures reportedly on the table. From changes to stamp duty and inheritance tax to a potential manifesto-breaking rise in income tax, Reeves faces a daunting task to balance the books, especially with the Office for Budget Responsibility slashing its productivity forecasts, costing an estimated £20 billion a year. So, what do you think? Is cutting the cash ISA limit a misguided attempt to boost the stock market, or a necessary nudge towards smarter investing? And is financial education the real key to changing our savings culture? Let's hear your thoughts in the comments. This debate is far from over.